Right, well, central bank moves and a gloomy outlook may cause some market headaches, but some investors might be in a risk-on mood. JP Morgan Asset Management releasing its guide to the markets. Joining us now, David Lebovitz, their global market strategist at JP Morgan Asset Management Global Market Insights team. Thank you for joining me this morning, David. So, a lot of people wondering, as you look at some of these different movements from different central banks around the world, is it an easier fix for the US Fed to be too hawkish and have to pare back versus being too dovish and then risking having to re-raise rates?
So I think when it comes to the Fed, the issue right now is that what investors want to hear and what the Fed's saying are two very different things. You know, investors are pricing in a Fed that eases policy aggressively during the second half of the year and, you know, effectively rides to the rescue as growth slows and financial conditions arguably begin to tighten. But if you listen to what the Fed is saying, they're saying, well, we're probably not done. And when we finally do pause hiking rates, we're going to pause. We're not going to do a 180 and begin to cut. And so, you know, when we think about the risk here, taking the over or the under on the Fed, you know, I think that the risk is that the Fed doesn't do enough and needs to re-engage later on this year. My base case view is that the Fed is going to continue going here, get rates north of 5%, and then leave them there until something breaks in a way that they are unable to ignore. And I think that is the better policy, because if the Fed has to re-engage with rate hikes later on this year due to a premature pause, that really means two things. On the one hand, it means that inflation has continued to become ingrained in the U.S. economy. And on the other hand, it's going to be very disruptive to financial markets who may have begun to feel that they were finally out of the woods.
I mean, this is a tough picture for the Fed. I mean, we're getting this cooler data in today from the ADP payrolls on top of what we saw with the JOLTS data as well. And then when you think of the tighter lending conditions after the SVB fallout as well, how tough is it going to be at the next meeting for the Fed to really justify staying the course at the moment?
So a couple of things there. One, when we think about what's happened in the regional banks, it feels very idiosyncratic. You know, the banks that have come under pressure for very specific reasons. But to your point, we may now be in a world where the market does some of the tightening for the Fed in the form of tightening financial conditions. What I would say here is that if you go to the doctor and you're not feeling well, you don't want the doctor to begin to panic, right? You want the doctor to say, we've seen this before, we know what to do, and have that bedside manner. I actually think that the Fed, you know, not going through with a rate hike at the May meeting would be bad bedside manner. It would send a sense that perhaps there's something bigger going on here. There's something, you know, more wrong than what we've seen over the past couple of weeks. And I actually think that would be more harmful to capital markets and to investor sentiment than the Fed going ahead with another 25 basis point hike, which, by the way, they telegraphed in their forecast. So you can listen to what the Fed has said, or you can speculate about what the Fed may do. I'm going to listen to what the Fed has said and base my investment decisions accordingly.
Yeah, and clearly investors still off to the races, not focusing on what the Fed is saying, or at least reading into it more than the Fed is ready to do at this point. I do want to highlight the strength of the consumer. We know that Jamie Dimon brought that up in the annual shareholder letter. And looking at some of the JP Morgan data on that, the consumer balance sheet, consumers more overweight in other financial assets than homes and pension funds. What's your take on that risk-on positioning, though, if we're supposed to be seeing all these recession signals flashing?
So, you know, the first thing that I would say is that equity ownership in the United States has risen over time and took a pretty smart leg higher during the pandemic. I wouldn't read too much into the way that consumers are allocated. I would focus more on the liability side of the equation and what consumers have to service from a debt perspective. And although we have seen a modest increase in the household debt service ratio over the past couple of quarters, effectively reflecting consumers swiping their credit cards more at grocery stores, at gas stations, in the face of higher prices, that debt service ratio remains well below the level that it stood at in the run-up to the GFC. And so, you know, yes, the consumer may be a bit more overweight equities today than they have been in the past, but the consumer's overall financial position continues to look very positive, and we do think that sets us up for, you know, a recession that is probably pretty average and not the outlier that we've seen the past two times around.
I mean, this is a very interesting dynamic we have for a recession here, given the strong jobs market still continuing. I do want to ask you about some of the trends that we're seeing in U.S. real estate. Highest vacancies for offices, understandable as we're coming off the end of the pandemic, but also retail vacancy rates still high, but falling in 2023. A big shift, though, of 36% to department and discount retailers versus a drop of more than 36% for some of these clothing retailers. What's happening in that dynamic?
So, what I would say about retail is the trends that are playing out are trends that were firmly in place prior to the pandemic. One of the things that we were seeing was that the more successful retail properties were oriented much more towards services and experiences as opposed to the sale of physical goods. I can buy a pack of 3 white shirts and get that delivered to my front doorstep in less than 24 hours. I don't need to go to a physical store in order to purchase items like that. But I can envision a world where, I go to the gym and meet a friend for lunch and maybe, stop at a grocery store on my way home. And that's what is describing the more successful retail properties today. Again, more of an orientation towards services and experiences, less of an orientation towards the consumption of, traditional consumer goods. You also mentioned the office space. We're back in the office as evidenced by where I'm sitting today. Office is going through a similar transition where the offices of the future are not going to be the cubicle farms that, I grew up going to for, 5 days a week, 70 hours a week, so on and so forth. They're going to have more open space. They're going to have more collaborative space, right? They're going to cater more towards in-person interaction rather than individual work. And so what we're seeing are these bigger structural trends playing out in the real estate markets in particular. On the retail side, it's a trend that really began in earnest prior to the pandemic. And in the office side, it's something which I think is going to gain a decent amount of momentum here over the coming years.
And as investors sort of look ahead, obviously we're not sure exactly when the Fed is going to pause or pivot. Still a lot to factor in between now and their May meeting. But we saw that the 60-40 asset allocation in people's portfolios, that really did take a hit last year. It was down, I believe, 16%. So far this year, at least year to date, up 6%, most of that driven by this equities rally that we're seeing. What are your expectations for the return of the 60-40 portfolio this year?
So in terms of our expectation for the 60-40 portfolio this year, I like to think that it'll be better than last year, which, as you point out, was the worst year for a 60-40 portfolio since 1974. My general thesis is that, bond yields probably end the year lower than they are today. Equities end the year probably around levels similar to where we are today. And so I do think that you'll see, some sort of positive return in the mid-single digits when all is said and done. I think arguably the bigger picture issue for us when it comes to the 60-40 portfolio is the improvement in expectations for long-term returns. And a couple of years back, we were of the view that a 60-40 portfolio would pay you, call it 4% a year over the next 10 to 15 years. When we marked those numbers at the end of 2022, that number had moved north of 7%. And so, we can debate the short run. We think it's going to be a better year than what we saw in 2022. But what I would say more broadly is that the long-term return expectation for a traditional stock bond portfolio has very much improved relative to where it stood, say, at the beginning of 2022.
We'll definitely be keeping an eye on that. We appreciate you joining us for your insights, David Lebovitz there, Global Market Strategist at JP Morgan Asset Management Global Market Insights team. Thank you so much.